Hello and welcome to the lecture for week 4. In this lecture, I'll discuss Learning Objective 4.3 in your reading, which is basically a review of what we ended with last week. So recording common adjusting journal entries, and I'll also talk briefly about posting them. The next, we'll talk about Learning Objective 4.4, which is updating the general ledger and using those ledger balances to create an adjusted trial balance. So last week we created an unadjusted trial balance. This week it'll be adjusted. And then last, I'll talk about preparing a simple set of financial statements using that adjusted trial balance. So some of the rules for adjusting journal entries. First, every adjusting journal entry is going to affect at least one income statement account and at least one balance sheet account. It could be multiples on both fronts, but it's always going to affect one from each of those two financial statements. Second, cash will never be included in an adjusting journal entry. It certainly can be used in a correcting entry, but a correcting entry and an adjusting entry are different. Briefly talk about that. So correcting entries come about through fixing a mistake that somebody's made, which is a very common thing. Somebody records something to the wrong account, you identify that and make a correcting entry where you change that account and another account in a corresponding amount. An adjusting entry, on the other hand, is something that you will probably do every single month. It's about recognizing expenses over time, recognizing revenue earned over time, getting amounts in the right period. All of those things are accomplished through adjusting journal entries. So you're always going to have adjusting journal entries. You may or may not have correcting entries, and cash may be included in a correcting entry. It's not going to be included in an adjusting entry because we want entries to cash to flow through specific journals or modules in your software. So a cash disbursements module or a cash receipts module is an example. The adjusting journal entry is going to reflect the amount that is relevant for the particular period in question. So it'll be the expense for the month, the revenue for the month, that sort of thing. So reviewing the transactions that were noted in your book, the original transactions, and then we'll talk about the adjustments to those. So I just want to review this list really quickly and point out adjustments or transactions that would result in future adjustments. So the first one, issuing $20,000 in shares of common stock for cash. There's no subsequent adjustment required there. Purchasing equipment for $3,500, payment due within the month. There's the only adjustment that is related to that would be depreciation. So based on purchasing equipment during the month, we would most likely record depreciation for that month. If we receive cash in advance from a customer for services yet to be rendered, well, that'll certainly require an adjustment to recognize at the end of the period what services we have provided, and if we've earned some of that unearned revenue that we created when we got that $4,000. Next one, providing services to a customer who is going to be billed. There's no subsequent adjustment required there. The same thing with paying a utility bill with cash, no adjustment there. Distributing $100 cash in dividends to stockholders wouldn't require an adjustment other than closing at the end of the year. Receiving $2,800 cash for a customer for services rendered, as long as it's, again, the services have been rendered, then that's an immediate recognition of revenue, no adjustment required. Paid in full with cash for the equipment purchased on January 5th, no adjustment required there. Paying cash for salaries doesn't require a subsequent adjustment. Receiving a cash payment in full from a customer doesn't require an adjustment if the revenue has already been recognized. Providing services to a customer asked to be billed later, which is similar to the transaction on January 10th. There's no adjustment there. And then purchasing supplies on account for $500, payment due within 3 months. There is an adjustment required for that because we'll want to reflect if we've used some of those supplies between the date of purchase and when we finish the month. So the adjustments that were talked about in the book that I want to review is number one, they took an inventory of the supplies and discovered that they had used $100 worth of supplies. So we're going to want to recognize supply expense for the amount that we've consumed and reduce our supplies asset. Next adjustment, equipment purchase on January 5th is depreciated $75, so we'll want to record that and increase that contra account accumulated depreciation that offsets the equipment account. Remember, contra accounts have a normal credit balance, a different balance than their neighbors. We performed some services during January and for the customer in the January 9th transaction, so we've earned some of that unearned revenue, so we're going to want to reduce the liability and recognize the revenue with a credit. Next, reviewing the company bank statement, Printing Plus discovers $140 of interest earned during the month. It was previously uncollected and unrecorded, so if we don't accrue that, if we don't recognize that, then it wouldn't be included in our books. And then employees earned $1,500 in salaries for the period that had previously been unpaid and unrecorded. So that's another accrual, another item that we need to add to our books in order for them to be accurate. We need to recognize that we've incurred an expense, people have done work for us, and we owe them money for that. So those entries will look as follows. That first entry, we've done this a number of times now, will debit supplies expense and credit supplies for $100. The second entry, we've done this a few times as well. We recognize depreciation expense by debiting depreciation expense and crediting that contra account, accumulated depreciation. Next, we record that we've earned some of that revenue, so we reduce the liability. If we quit today, we wouldn't owe the customer back as much money as we did when they initially paid us, so we reduce the liability of what we potentially owe back to them, and we get credit for the revenue that we've earned, so we credit service revenue. The next entry, this is the publisher's solution, and I disagree with it. They're indicating we would debit interest receivable and credit interest revenue. In this case here, I think we would debit cash because we're seeing this on a bank statement. So it's not a receivable, it's cash. So I would debit cash and credit interest receivable. Maybe they made this mistake because they also made the claim that cash is never in an adjusting entry, but all the same, this is what the publisher showed. And then lastly, we've done this several times as well. We would debit salary expense and credit salaries payable to reflect that people have done work for us and we owe them money. Once we've done that, we'll post each of these entries to the general ledger. And here's a general ledger that's in a little bit different format than what we've shown before. This is a T account format general ledger. What's nice about it is it's a little bit easier to see what is flowing in and out of accounts. But this is similar in structure, at least, to the general ledger that we did before that was, I think, a 6-column general ledger. So here we can see as an example on supplies, we see on the credit side the $100 January 31st adjustment. And then if you go over to the far right column under supply expense, about halfway down, you see the debit for January 31st, 100. So any entry that's dated January 31st is an adjusting entry, and the other entries that are shown on other dates in January are the other transactions, the initial transactions that occurred during the month before we recorded adjustments. So once we do this, we can subtotal each account, so we can see under cash, if we take the debits and subtract the credits, we end up with a debit balance of $24,800. Receivables, same thing. We add the debit, subtract the credit, we get a debit balance of $1,200. We always record the balance on the side that has the balance in it, and it should correspond to the normal balance for assets should be a debit, the normal balance of liabilities should be a credit. So once we've done that, we can transfer those amounts to an adjusted trial balance, which in format looks exactly like an unadjusted trial balance. It's just that the figures now represent the adjusting journal entries that we made. So we may have several cycles of this. We may print this adjusted trial balance and then look through it very carefully and do some reconciliations and find other adjustments that need to be made. There may be multiple iterations of recording further adjustments, posting them to the general ledger, creating a new adjusted trial balance, and then reviewing that. That's quite common. I'd like you to hit pause here and do the first two in-class practice problems. That's PA 14 and PA 15. So do those two problems and then compare your work to the solution on Canvas. And always you can follow up with me if you have any questions. So once we have an adjusted trial balance that we feel good about, we'll then create the financial statements. And we're going to show three simple financial statements and talk about kind of where the figures come from. So the nice thing about the order in which the trial balance appears is that it's in account number order, if we had account numbers here, but it's basically in financial statement order. So you can see here we start with cash and followed by other assets, and then we have liabilities. After that, we have the stockholders' equity accounts, and then we have revenues and expenses. So I could draw a line from interest revenue and across, and then every account below that would be on the income statement. So the income statement is revenues minus expenses equals net income. That's the formula for an income statement. So in this company, they've got multiple different revenue accounts, interest revenue and service revenue. So they have a header, revenues, and they include the detail in that kind of middle column, or the column to the left. And then the total is in the far right column for total revenues. The purpose for that is that far right column needs to work by itself. So 10,240 minus 5,575 equals 4,665. If I want to know the detail supporting 10,240, I look to the left to see that detail. That's followed by expenses. This publisher doesn't follow a rule that I always do, which is to put them in descending order. But again, if I want to see what the detail is supporting 5575, I look to the left. So these two columns represent subtotals and details, not debits and credits. Okay, the debits and credits for two columns, that's on the trial balance, but not on the income statement. So this company had a profit. They had net income of 4,665. We do the income statement first because we need that net income figure in order to do the second statement. And the second statement in this company is the retained earnings statement. Now, if a company doesn't have any stock transactions during a period, they don't issue any new stock, they don't buy any shares back, then they can do just a statement of retained earnings, which is a reconciliation of the activity in the retained earnings account. Where did they start? What was added to it? What was subtracted from it? What is the ending balance? If they did have stock transactions, then this would be expanded and they would also show a reconciliation of the common stock account. It would be a statement of stockholders' equity, not just a statement of retained earnings. So in this company, it started the year as a brand new company. So on January 1st, the balance was zero, which I would have personally put a zero there rather than leaving it blank. And here we add net income to that. So again, that net income came from the income statement. Then we subtract dividends to get the ending retained earnings balance of 4,565. Now we do this statement second because we need that ending retained earnings figure in order to do the next statement, which is the balance sheet. So the balance sheet is going to come from that top range of accounts on the trial balance. So I start with assets, and it's traditional to list them in order of liquidity. So starting with cash, followed by accounts that will either turn into cash or be consumed next. So after cash is usually accounts receivable, any other kind of receivables, and then prepaids and supplies. And you can see followed by equipment or land or buildings or long-term type assets. So again, in this example here, we show accounts that don't require subtotals along the right. So we have cash of 2480, accounts receivable of 1200, and so forth. And then where we have equipment minus accumulated depreciation, that's the detail that supports the 3425 subtotal or book value for equipment. So in this case, I have assets of 29,965. I then list my liabilities, and they can be in any order, and that's followed by stockholders' equity. And again, that ending retained earnings figure of 4,565 came from my statement of retained earnings. And then finally, I add total liabilities and total stockholders' equity and get a balance of 29,965. So the key thing there is it has to be in balance. just like the accounting equation, total assets have to equal total liabilities and stockholders' equity. Once it equals, we know we probably haven't made a mistake. The last thing I want to talk about, and actually I apologize, if you could hit pause and do the next in-class practice, which is PA 18, and then check it against the solution, that would be great. So the last topic I want to cover in this lecture is a classified balance sheet. And what classified means is that we're going to group accounts and provide subtotals to give more information to the reader of the financial statement. Our goal whenever we create a financial report of any kind is to provide all the information that we believe the reader is going to use in a format that is understandable. So if I want readers to make comparisons between subtotals in my balance sheet, well, then I should provide those subtotals. One that's done very commonly is separating current from long-term figures. So current assets, this is a definition you'll want to remember. Current assets are assets that will be either converted to cash or used up within the upcoming 12-month window. So it's not before year end, it's within a moving 12-month window what meets that criteria. Everything else is a long-term asset. The common category you usually see is property, plant, and equipment, which are long-term tangible assets. You might also have long-term intangible assets or investments. There could be other longer-term categories, but current assets is the key. On the other side of the balance sheet, current liabilities are also key. So those are debts that will be paid within the upcoming 12-month window using current assets. So if our intention is that we will roll the debt over and replace one debt with another debt, then it wouldn't be called a current liability. It would just be those that we intend to use current assets to pay, primarily cash. And then long-term liabilities are any debts that come due beyond that 12-month window. Now this balance sheet looks a little bit funny because it's in a European format, so it conforms with international financial reporting standards. What's different about it is they show the long-term assets first, followed by the current assets. In the US, we do it the other way around. But what you can still see here is there are current assets in this company of $1.2 million. And then look down below and you'll see long-term liabilities, and at the very bottom, current liabilities. Those are liabilities that come due within the upcoming 12 months, which in this company total $1 million. Comparing those two numbers offers you some insight as to whether or not this company is likely to be able to pay their bills when they come due. So if somebody is asking you to grant credit to their business, asking to see their balance sheet, comparing the current assets to the current liabilities and calculating that ratio is a key thing to do. A rule of thumb, and this varies by industry for sure, but a good rule of thumb is you want the current assets to be at least double the amount of current liabilities, so a ratio of 2 to 1. You can see here, this is a ratio of 1.2 to 1, so it doesn't meet that criteria. I would be a bit nervous about granting this company credit in terms of whether or not it'd be paid on time. So that's the end of the first lecture for the learning objectives for week 4. I will record a lecture for the remaining lecture for week 5 next week, and I look forward to talking to you then. Thank you.